think that bewitching hour is upon us. I'd like to thank everybody for coming out today. We've got a nice group. Let me begin by saying that today's program is sponsored by Jessica Daniel, who is our member, CPA member here with the Lake Barkley Chamber. And poor Jessica is just too shy, basically, to do her own presenting. I said something to Marcia Daniel about that yesterday, and she said, yeah, she's telling the truth. Because I seen her present. Anyway, that doesn't reflect upon her CPA ability. But she has invited today Stacy Boone from, I get this right, CPA with the Furman Campbell Group in Princeton, along with Holly Green. Now, for your benefit, we're going to go around the room and have everybody introduce themselves so you know who you're talking to. Let's start with Fred, right here.
All right, Fred Folds with Woodall Insurance in Princeton. Brad Harrelson with Woodall Insurance Agency in Princeton.
With a mouthful.
Sharon Adams, Caller Medical Center.
Judy Stone, and I'm retired.
Clyde Adams, Independent Life.
Taylor Smith with Verizon and Core Fitness.
Kimberly Shoulders with Breakfast Band. Joanna Vogel, Regional Glass.
Katie Center with Fifth Avenue.
Jody Norwood, I'm gonna hear it later.
Mary Albert with Travel Leaders.
Paul Shaw with Marathon Road.
Heather Ward, Christian County.
Jim Stott, Bayview Properties.
Thank you very much. All right, with that, Stacy, program due.
All right. Did everybody get an outline? You got one? Okay.
We ran out of them.
Oh, okay. All right. Okay. Okay. When I was trying to decide what to bring, you can tell I'm old school. The thought of a PowerPoint presentation terrified me, so I have this trouble at work. I want something that I can feel and I can flip through the pages and I can make notes on, so I just decided to do a handout. And if you look at the handout, there's really not a method, it's just more madness than method. It was as things came to mind. What I tried to do was pick up on different things that people ask us about throughout the year. Questions that they might have. And so like I said, there's really not a theme. If we get through all of this, that's fine. If we don't, we'll stop whenever it's time to stop. If you all have any questions, please just feel free to ask them. When I was talking to our manager in Hopkinsville, I called him and said, do you have anything like this? And have you done a presentation? He said, oh, I've got this 8-hour webinar that I'm going to do on tax updates. It'll be just exactly what you need. So I pulled it up the other night and I'm looking at it and it was Supreme Court cases and court rulings and I'm thinking, I'm not going there. So he said, now, if you open it up for questions, you're going to be asking for trouble. Well, I may be asking for trouble. So I'm okay with questions. If you all are okay with me saying, I don't know, I'll have to look it up. So we'll just start. The first thing that came to mind was, I don't know how many times I have somebody come in, sit down at my desk and say, so-and-so told me I could do this. And it may be completely legitimate and it may be completely off the wall. So my first comment is, when you start talking about taxes to somebody, talk to somebody that you can trust, because everybody has lots of tips and tricks and things that they think you need to know may or may not be correct. And sometimes the tax law doesn't always follow common sense. So just because it makes sense doesn't mean that it is acceptable practice. So find somebody that you trust, whether it's a tax preparer, whether it's somebody that you know knows tax law. When you're out there on Facebook or just talking to people and they throw all these tips and tricks out, don't automatically assume that they're as correct as they should be. when we talked about the program, I said, well, what are you exactly looking for? Well, just something, you know, kind of in preparation for tax season. And so the next thing that came to mind was, when people come in and sit down at our desk, they may have things on a computer, they may have a computer printout, they may have a shoebox of receipts, they may have a handwritten list. It doesn't, there's not a magic organizational system to prepare your taxes. It just has to make sense to you. And it has to make sense to your tax preparer. And so it's, sometimes I've even done check sheets. So when I'm sitting there talking to somebody, I have the way that I put things into the system. I try to, as we're talking, I try to make those notes in the manner that I put them in the system. But just because it might look pretty on paper, if it doesn't work for you, it doesn't work. We have these things called organizers that the powers that be at Thurman and Campbell decided we should send out. The first year we sent them out, they were 23 pages long. And we would have people come in and go, what is this? I have no idea what this is. And it was useful information if you knew how to read it, but it didn't make sense to a lot of people. And so finally, what we decided was, if it makes sense to you, and we'll try to make it make sense to us, just be organized. That's the main thing. Make a list of what you need, and a lot of times, your prior year return is a good place to go for that. You can see on each line what that is: W-2s, child care payments. You can see, if you look at those returns and you read the lines, you can see what they are. So that's a pretty good place to start. But if you have information, if you have a system of information that's been working for you for a lot of years, it's working for you, it's working for you. It doesn't matter whether that's what somebody else would do. But I did find online a list of, and that's what all of number 3 is. It's just the items that you might want to start with. Everybody knows their W-2s, 1099 interest statements and dividend statements. Those are things that you get in the mail. You may or may not have sales of stock. If you do, you'll have a form that comes in the mail to you. 1099s are kind of a hot topic anymore. The IRS has started being able to track those. So if you have 1099s, if you're a small business and you have some income that comes to you, and at the end of the year you get 1099s for that income, it's usually a good idea on your return to identify that 1099 and then throw everything else into other revenues, because the IRS will track those 1099s. And we've had them come back and say, hey, we have this 1099, but you didn't report it on your tax return. Well, it was in a sales number. We just didn't break it out. And so then you have to respond. So what we've started doing is, if there are 1099s, we list those 1099s individually and then lump everything that's not 1099 income in separately. Because, like I said, that is something that they can track. They're doing a lot more cross-checking. And, the rule is, if you pay somebody with some limitations, more than $600, you're supposed to issue them a 1099. And we've gotten to the point with a lot of taxpayers that if there's something that you were obviously supposed to issue a 1099 for, it works with farmers a lot. If they paid somebody to fix a tractor and they paid them $3,000, there should be a 1099 there. And what you run the risk of is, if you don't issue that 1099, or if you issue that 1099, the IRS will track it to that other person's return. So if you're that repairman and you haven't reported that 1099, the IRS may come looking for you, because it's simply a cross-check of ID numbers that they can track really easily.
Stop right there. Can I ask you a situation? Even if they took it to like a tractor dealer, let's say, for repair, not just Joe blow on the side of the road?
The rules are, it's not an incorporated business, or if it's not, what's the other, well, is it I don't think LLC is a qualifying 1099, is it?
They don't do it tonight.
Right, it has to be,
It has to be a sole proprietor.
Or an independent contractor.
yeah. So the rules are a little bit tricky on that, but if you're taking it to Hudson's, they're incorporated, no. There's no 1099 in play there. But if it's an individual, I know we have to get 1099s for like bookkeeping that we provide because we're not,
We're a partnership.
yeah, and partnerships require 1099s.
And the best way is if you're gonna get work done by Joe Blow on the street, is you give him a W-9 and he has to fill it out that says whether he should get it to 99 or he should not get it to 99. So the responsibility is for you to get that W-9 filled out and for them to say, no, you don't need to issue one, if there's any question.
And it's a whole lot easier to get that information before you ever make a payment, because if you've given someone their payment, they may or may not want to give you that information. And when you haven't issued that 1099 correctly, then you run the risk of that being a disallowed expense on your tax return, bottom line. So that's, the 1099s are a little tricky anymore. Anybody else? Any questions?
Okay, let's expand that. just a
Okay.
little bit. You said not an allowable expense, but for businesses. In other words, I mean, if I as an individual, and I have my tractor repair, and I'm not filing a business return, 1099s are no consequence?
If you're an individual and you've paid someone for a tractor repair, you run the risk of, in an audit situation, that expense could be disallowed.
If you
Yeah,
have
but
a
I'm
schedule
not claiming it as an expense, that's what I'm saying.
Oh, no, if you're not claiming it as an expense, then the IRS doesn't care. No, if you're just an individual, yeah. But if you're taking a deduction for that expense, and this would be an extreme, but if you're taking a deduction for that expense and the IRS determines that a 1099 should have been issued, there's a possibility that they could disallow that expense, but that's only in businesses. Okay. The next thing that you would get would be 1099Rs for retirement income, and you'll get them from a slew of different places. For a lot of times you'll get them for each investment maybe that you're invested in, and so you may end up with several of those. Business income and expense, that's whatever record-keeping system you're using. And then it gets into the tax credits, and we'll talk about tax credits in a little bit. Then there's a list of the expenses, itemized deductions, and I've got that listed on further down, so I'm just kind of going through this quickly. If you see anything, you have any questions, give me, just yell out. But one of the other things that we notice that people miss is a lot of times, and it's my fault because I'll be sitting there and we're chatting about your kids or whatever, and I haven't asked you, is your bank information current? And if we send your tax return in electronically with a routing number that is not valid, your refund is delayed significantly because they'll try to send it, the bank won't accept it, they'll send it back, and then the IRS dumps it in this file 13 over here that has to be paper, has to have a paper check. And so if I forget to ask, you'll help your tax preparers remind them if your banking information has changed, or if your bank, if you didn't have it direct deposited in the past, but you want it direct deposited now. But it is it's a pretty significant delay. I mean, it can take your refund from 2 weeks to 12 weeks. So make sure your bank information is correct. That's one of the things that we do.
Who gets refunds anymore?
Oh, you'd be surprised. But we had last year, no, 2 years ago, the bank in Princeton went from, I don't remember, it was Integra to Landers. There's a couple in between. And so there for a while, all of that bank information was changing because the routing numbers were changing. So everybody that came in that had that particular bank, you had to remember to, did you change your bank account? And a lot of them had changed banks. So don't forget to give your banking information and make sure it's correct if you had it in there. There are a lot of credits that are available for tax returns. One of those areas is education. The rule is if you claim that person as a dependent on your tax return, that's where the credit has to go. That Social Security number on the 1098-T has to be linked to a Social Security number on your return. Doesn't really matter who paid it as much as who is claiming that dependent. And so that's one of those things when you have a college-age child, you have to look at, is it more beneficial for me not to claim them and get the benefit of those education credits, because education credits will top out at certain income levels. So if you have a high-income parent, sometimes it's much better for them not to claim the child and allow the child to claim those education credits, and that way you get more of a benefit. They haven't maxed out, especially if it's one of those situations where, you know, there are specific rules for who's a dependent and who's not a dependent. Sometimes it's a gray area with college students because, you know, they're partially independent, they're not independent. So if you've met those, if you can go either way on the dependency rules, that's something that you need to look at on the education credits, because there's one, the American Opportunity Credit, that's really good, and it's a refundable credit. So that means that even if you don't owe any taxes, it'll add back to your refund. And that's a $2,500 credit. So those make a difference. There's also the lifetime learning credit and the tuition deduction. Those flow through your return in different ways. Basically, the American Opportunity Credit is available only for the first 4 years. And so that's the other thing. If you've got a high school student that's taking college credit courses their senior year, and they may have, you know, $500 or $1,000 on the 1098-T because they legitimately took credit, don't take that American Opportunity Credit when they're a senior, because you're going to get a lot more benefit out of it when they're a freshman and their college expenses are $10,000. And if you use that American Opportunity Credit that first year, you only have 3 years of college left because it's a 4-year max. So be careful with that one. The American Opportunity Credit will also allow books. It covers tuition, obviously. It will cover books. It'll cover classroom fees. So don't forget to pick those kind of things up when you're figuring that American Opportunity Credit. The others don't cover those, but the American Opportunity Credit does. So don't forget those expenses, because that's something that usually everybody gets the 1098-T and they'll bring it in, and so I'll ask the question, what about the books? I don't know. So anybody have any questions on charitable or on education credits? Charitable contributions. It has to be an approved IRS organization. You can go to the IRS website and there's a search feature for eligible organizations that have attained that tax status. So it has to be, some of the things that you might think are charitable contributions really don't qualify because they're not an approved organization. Documentation is necessary. I don't know how many people that I've had come in and say, I gave $200 to Roadblocks. I want to take that. If you don't have the documentation, it may not have to be in the form of a check. The IRS says you have to have some kind of documentation to legitimize those contributions. So if you just gave a couple bucks in the Roadblock, unless you've got some kind of documentation. And this is what I tell my clients. The only time these things matter, I'm not going to say the only time these things matter because, you know, we all try to do the right thing. When these things really matter is when the IRS sends you a letter and says, hey, we want to audit your tax return. And they're not going to know whether you have that documentation unless they pull you for an audit. And they've gotten, what we've seen recently is they'll audit segments of a tax return more than they audit the whole thing. I had a client that got, it was just a random selection, got pulled for a comprehensive audit from line 1 to refund. And they did go through every single line on his tax return. A lot of times, somebody will get a notice if they have a lot of employee business expense on their Schedule A. They'll get a notice that says, hey, we want you to show us the documentation for these expenses. They'll pull a particular area of your return, but they still do comprehensive audits. So when these things really matter is if you get pulled for an audit. And if you get pulled for an audit, if you don't have it, it's going to be disallowed. So you don't have to prove it to me. You just have to know that you can prove it to the IRS if they ask for it. So anyway, documentation is necessary. You can't just throw that $200 on your Schedule A as a contribution and say, this is what I gave, but I don't have any documentation for it. They don't care.
How far back can they go on audit? Is it 5 years?
I think they can go 5 years if they're, and if they find something, I think they can go an additional, is it 3 or 5 or 7? 3. They can, if they find an issue, then they can go back further. So I think we all probably breathe a sigh of relief every time that year gets dropped off that we can't go back, because nobody, even if you've done everything right, nobody wants to go through the pain of an audit, and they can be painful. The other thing that we have questions about is non-cash contributions. If you go out and you buy supplies for Vacation Bible School, keep those receipts. It's a legitimate deduction. Goes on a separate place on your tax return. Be sure to keep cash and non-cash contributions separate, but it's a legitimate deduction. Mileage, there's charitable mileage. I think it's 14 cents a mile, so it's not a whole lot. But you know, if you're in a situation where you have significant itemized deductions, every little bit helps, and that's not reduced by anything. So, and generally, I use the same rule that you would use for business mileage. Commuting miles are not. Mileage that I drive from my home to church, that's not a charitable mile. If I go to church and I pick up the youth group and I take them to Nashville, that's a charitable mile. And you'd be surprised. Those miles can add up. Then I've got, what did I do with all of that paper? The most overlooked tax deductions. And I think a lot of these, I found the 6 most, the 10 most, the 50 most. So we're just going to run over a couple of these. Accounting fees and tax prep. I tell you what, let me back up and preface this with something. You can chase itemized deductions all year long. But the rule is, if your itemized deductions are less than your standard deduction, you take the standard deduction. You get the bigger of itemized or standard. So if you're married and filing a joint return and you don't have more than $12,600 in itemized deductions, it doesn't matter how good your documentation is, you're going to get the standard deduction. There's no sense in tracking all that stuff. And you'd be surprised. That's probably what people spend more time on. I got to get all my medical stuff. I got to get all this. I got to get all that. But if you don't have more than the standard deduction, save yourself the time and just take the standard and don't pull your hair out trying to track all that stuff. And I always say that with hesitation because you never know when something catastrophic will happen. And this year you may have taken standard, next year you may be able to itemize. So just kind of keep in your mind, do a mental tally. Did I have anything significant in medical? The biggest thing on the Schedule A is usually mortgage interest, charitable contributions, and taxes. And your taxes are your local and state taxes, and that's what's paid on your W-2. So if you look at your W-2, and in city and state taxes, you have $5,000, you're almost halfway there to your itemized. So kind of keep those things in mind. But, you know, if you look at your W-2s and you got $3,000 and you know your mortgage interest is 3,000, you're 6,000. If you don't have anything else, you're probably not going to get close to that 12,600. Save yourself the headache and don't worry about those itemized deductions. Take the standard and be done with it. Because like I said, that is one thing that I think people spend a lot of time on. Medical deductions get reduced by, if you're under 59, I think, 10% of your AGI. If you're over 59, 59 or 65? 65. If you're over 65, they get reduced by 7.5%. So if you've got $100,000 on your AGI, on your tax return, and you've got medical expenses of $3,000, they're never going to help you anyway. Doesn't mean they're not deductible, it just means that they're not going to help you because the standard's going to kick in unless you have other things. So there are things on your return that have to jump through hoops to ever get there. And sometimes we spend a lot of time looking for those little things when they don't matter. I know I had a young couple come in and they bought a house. And so they were really excited the year they bought the house because they were like, we're gonna be able to itemize. We're gonna have a mortgage interest deduction. Well, they'd gotten the standard the year before, close to 12,000, whatever it was that year. And their mortgage interest wasn't anywhere near that. And so when they got their return, they were like, they thought they were going to get all this money back. And so when we went back and looked, it was like they were able to itemize. I think their itemized deductions were $300 more than their standard deduction would have been. So, you know, we have the concept that these things are going to hit dollar for dollar, and the truth is they don't always do that. So, accounting fees, there are treatments when you start looking at medical expenses. There are certain treatments that are deductible, some that aren't. Cosmetics, any kind of cosmetic surgeries are not. Let's see, casualty and theft losses. If you've had an insurance claim, don't forget that. Have to jump through some hoops, but contact lenses, eyeglasses.
Could you elaborate on that just a little bit on the insurance claim?
Uh-huh.
So, if I have a loss, my house is damaged, let's say, it's personal, my house is damaged, it's $10,000 damage claim. And the insurance pays 80% of that. What am I claiming as a loss?
You would claim the total amount of your loss, less your insurance, less, I think it's a $500 automatic floor that it has to be. And then it hits your Schedule A, and so it flows into your itemized deductions. So if you have a significant insurance loss, it can come into play. I know during the ice storm, we had several people that had enough insurance losses with trees and things like that. So
Even though the insurance paid a large amount of it.
as long as it's, yeah, what you can take is the loss less the insurance.
So if it's $10,000 and the insurance paid $8,000, my loss is only $2,000.
Actually, your loss would be $1,500 because they take, yeah. So it can, sometimes it can be enough, it depends. I mean, there's not a set rule of what hits, but, you know, then it gets to your Schedule A, and if your Schedule A flows through and it's more than the standard, then you can get some benefit from it. Contacts, eyeglasses, hearing devices, they're all deductible. Dues to labor unions. I know I've got several guys that work constructions and their dues are outrageous. They hit on the Schedule A down in the bottom section, unreimbursed employee business expenses. There again, it has to jump through some hoops, but you know, if they're paying $5,000 in union dues, they're probably going to get a benefit there. Let's see. Gambling losses, to the extent of gambling winnings, you have to report the winnings, but you can then on Schedule A deduct the losses up to the limit of the winnings. Investment fees, that's one that I think a lot of people forget because you don't always see that you don't write a check for it, it comes out of your statement. So a lot of people don't think about those investment losses. Long-term care insurance, there are some limitations, but it is a deductible expense. If you are self-employed and you're making health insurance premiums, talk to whoever does your tax return and ask them how they're putting those on your return. Because if you put them on the Schedule A, you can get a benefit for them, but you can put them on you can link them to your Schedule C, and you get an above-the-line deduction for health insurance costs that automatically reduces your taxable income. So dollar for dollar. Sale of real estate, don't forget points and commissions and all those kind of things. Let's see. One thing that we run into is investors will sell stocks, and people will get these investment statements at the end of the year, and they'll have these huge capital gains on them. And they weren't expecting it, first of all. They didn't get the money rolled back into their account, and so they've got capital gains on all of these stocks. Talk to your investment advisor. Make sure that he's selling losers in addition to the winners, because a lot of people get surprised at the end of the year when those investment statements hit, and they've got this tax burden that they were not anticipating. So make sure that you talk to your investment advisor and make sure he's selling the losers along with the winners to offset those things. So, anybody got any questions so far? I'm either doing a really good job or I'm phased out.
This stuff gets so far over everybody.
Well, it does, and that's the reason why I prefaced this whole thing with, you can ask any question, just don't be surprised if I say I don't know. I don't know. So there are a lot of things. Mhm.
Are there any major changes in 2015 that you
There
that we
are
need to be aware of?
a list of things that, where is that? And why is the IRS calling me? There really aren't any big changes. I mean, Affordable Care Act has already come down the pipe. Probably the biggest thing that you need to know is last year, if you bought health insurance through the state exchange, you got a form that you had to give to your tax preparer or you had to include on your tax return. It's called a 1095-A. This year, anybody that has health insurance is going to get a 1095 form, and that 1095 form has to be included on your tax return. So if you had insurance through an employer, if you had insurance through a private company, you're going to get a form that tells you how much premiums you pay, and that is going to be relevant. So you may get it and look at it and go, I don't know what this is. The 1095As were a full-page form. In the middle of them, they had a grid that had the amount that you paid and the silver plan, the acceptable or the normal silver plan, and then there was some other information, but it'll be a full-page form, and it'll either be a 1095B or a 1095C. Have your name on it, and your health insurer's name. So that's the biggest thing this year. When you get those, hang on to them, because they're going to ask you for them when you do your taxes. There are some things, right now they have not extended 179. Right now it's set at 20,000. So last year it was 250,000. So if they don't extend that, that will significantly impact small businesses. Let's see. I've got a list here of expiration of tax provisions. The credit for residential energy, insulation, doors, windows, geothermals. Some of those expire in 16. The American Opportunity Tax Credit, which was the education thing that we were looking at, that thing expires in 17. Who knows that? And this is as of today. They may extend them, but as of today, these expire. The Energy Efficient Appliance Credit, that was the one that everybody that bought a refrigerator came in and said, my salesperson told me I was going to get a tax benefit for this. It expired in 2013. They'll tell you that, and sometimes the states will have funds set up for gas appliances or electric appliances, but the federal government doesn't do that anymore. Geothermals expire in 16. The educator deduction, anybody a teacher? Educators get a $250 above the line deduction. That goes away. It's not extended this year. They may extend it, but that goes away. Then we talked about the 179, the AGI floor on medical expenses for seniors changed last year, and the tax-free distributions from IRAs. There was a provision that if you had a minimum required distribution or any distribution from an IRA, if you allocated or specified that distribution to go to a charitable organization, it's not includable in your taxable income. That it's set to expire in 14, they extended it to 15. We'll see what they do with it from there. But other than that, to answer your question, Fred, there really aren't nothing new coming up this year. Okay.
On that 1095 A, B, or C, that's going to be the way that they track to make sure that we have qualified health insurance, isn't it? Whether it be a purchase made by ourselves as individuals or through a group policy.
Right. Yeah. And they'll start reporting, I think they started reporting last year or the year before last, your employer's portion of the insurance that was paid for you. That started being tracked on your W-2. So the Affordable Care Act, I think, will probably continue to be an issue of change. Who knows what they'll do with it?
Is there a way to deduct, I guess you'd have to figure it out percentage-wise, like the credit card fees for state tax that you're collecting, like sales tax? Because basically, you're paying the credit card fees for the money you're collecting for the state. Does that make sense?
As a business, that's a business expense.
Okay, so you can deduct 6% of your
Yeah.
credit card fees?
It's the cost of doing business. Credit card interest, I'm sure you all know, is not deductible on the Schedule A, but interest, when it is associated with a business purpose, becomes deductible that otherwise would not be deductible.
You're gonna be able to deduct all of it. I mean, all of your expense, like your 3% that it's costing you to collect for the use of that credit card.
Yeah.
I mean, you get to deduct it all of it. So collecting your sales tax, you don't know.
Okay.
Yeah, if you're paying sales tax above and beyond what you're collecting from your customers, that's business expense. Let's see. Okay, we talked about deductions, we talked about what's new. I don't want to hit on this, I just want you to be aware of it. Don't lose your carryovers. If you've got carryovers, then sometimes if you have investment losses, you're limited to $3,000 of those investment losses, but it carries forward. And so you can continue to use it. Don't forget to pick those up on your next year's return. Most tax preparers have software that tracks that, but if you change preparers or if you're doing it yourself, don't forget to pick those things up and pull them forward. There's a net operating loss. If there are limitations on your charitable contributions because of income, those things will carry forward and you can use them as they become available. Energy credits. I have one client that, bless their heart, they put in a geothermal unit, which had a huge energy credit, and they retired. And their income dropped to the point that they've got this credit setting out there, and so we're trying to figure out how to best utilize this credit to get them some benefit from it, because right now, in the last couple of years, they haven't been able to pay anything. So those credits sit there, so don't lose them and forget that they're there. And then capital losses. This is a point that we have answered. I don't know how many calls we had. The IRS will not call you by telephone. I'm sure you've probably heard it on the radio. They won't text you, they won't email you, they won't call you.
I just got one yesterday, an email.
Yeah. They will only contact you by written letter. So if you get any of these other calls, it's not the IRS. It's scammers. And I had one person call and they were concerned, and I said, no, the IRS won't call you. And called me back the next day. Well, they called again. And I said, the next time they call, tell them that you've reported this to the local police. And because they were doing that in Princeton, they were tracking it. So they won't call you. They will only contact you by written correspondence. Don't be afraid to look at the IRS website. I promise they can't track your internet activity. They won't know what you were looking at. And there's a lot of useful information. There's a great search feature, and we use it all the time for research. There's a great search feature. If you can even get close to what you're looking for, they'll pull up a list of things. So if you have a question, it's right from the horse's mouth if you go to the IRS website to see what they have to say. Don't be afraid to use it, because they do have some good.
Can you not see 1099s that's been filed either on your federal tax ID or your social security? Like 1099s that I may receive will file for me.
From the IRS website?
Yeah.
I don't think so. They don't have personal portals at this point, and that would be personal information. I've never heard of any source that you can go to the IRS website and pull up any kind of personal information like that. I mean, if you want, you can check on the status of your tax return, but you have to know your refund, you have to know the filing social security number. So they do have some portals on there, but I don't think 1099s are on there yet. They may be at some point.
For some reason, I'm thinking my account years ago come up with something. But anyway, maybe not.
Yeah.
That could be a misconception.
Yeah, I don't know. I like I said, I've never encountered that. So, there are a couple of things with self-employed business expense. Mileage versus actual. If you're driving miles for your business, is it better off to take the actual cost of the vehicle, or is it better off to take mileage? Benefits are if you have a year that you've got high net income and you need something to bring it down and you bought a vehicle, you can take that, you can expense that vehicle through 179 and that year really pull it down. Takes away your depreciation in the following years. But there are some tips and tricks like that that you can do to reduce your tax burden. Be sure you don't hurt yourself by doing that. I had a contractor, and we had started taking mileage on his truck, and he traded trucks, and he said, I'm not taking mileage this time. And I said, really? And he said, gas was $3 a gallon at the time. His truck got 8 miles to the gallon. It was a lot better for him to take actual than it was to take mileage. So you can't flip-flop back and forth, but you can, when you trade vehicles, you can choose a different method then. So same is true with home office. The IRS came out with a new provision last year or 2 years ago. There's a standard home office deduction, $5 a square foot. You don't have to take a portion of your utilities. You don't have to do all of the mortgage interest and whatever. And it will take the better of, if you put the information in our system, our software will take the better of. But that standard home office deduction, you didn't have to document anything other than the percentage that you were taking. You just got that deduction. So, and that was actually one that you could flip-flop back and forth. I was just going to touch on the Affordable Care Act and the employer. Fred, I said there weren't any changes coming in 2016. I mean, that Affordable Care Act is coming in stages. I don't really want to get into that unless you have a specific question. Know that if you are a small employer, there are some breaks that you do have to report, you don't have to report. The other thing that you need to know is if you are a small employer and you're looking at a health insurance credit for the insurance that you pay for your employees, if you didn't buy it from the exchange, you don't get the credit. So if that's a credit that you have gotten advantage from in the past, you didn't buy insurance from the exchange, and a lot of times what the employers have found is it's more expensive to buy it on the exchange than it was with their provider that they've been using. But it took away that deduction unless you bought it on the exchange. So that's all I have. Do y'all have any questions?
Got one. For people that would be thinking about starting a small business and wanting to deduct things like computer mileage, whatever, would they necessarily need to form an LLC or something like that? That I know they would be advised to and able to deduct everything, because otherwise you've got the 12,600, you've got to add them all up. I mean, I've got 3 LLCs, so I'm not asking for me, but just,
right, yeah. The thing about an LLC is the IRS doesn't recognize an LLC. You can be an LLC, but according to the IRS, you have to be something else. You have to be a sole practitioner or a sole proprietor. You have to be a corporation. You have to be a partnership. You have to be some form of taxable entity. So, what the LLC provides you is that liability break between your personal assets and business activity. The other thing that an LLC doesn't do, that I always thought it did, an LLC does not protect your personal assets from personal injury. So if you're operating a small business out of your home as an LLC, somebody walks up your steps and trips and breaks a leg and wants to sue you, they can still get to your personal assets. It does not replace a liability insurance policy.
No, that's not my question. I'm just saying, for the person starting the new business, wouldn't it be advisable to have some kind of a business set up in addition to your personal? Or can you just say, I'm married, filing jointly, and we're running a business and I want to deduct all these
You can
business?
operate it as a sole proprietor.
Right.
And that's probably the simplest form, flows through your personal return. Anything that doesn't operate as a sole proprietor and flow through your personal return is going to be a corporation or a partnership that's going to require an additional tax return and additional administrative fees. Anybody that comes in my office and says, I want to start this business, what do I need to do? If it's not a proven business, start it as a sole proprietor. Don't set up all of that administrative stuff and create all that framework that you have to have corporate minutes and you have to have corporate board meetings and you have to do all this. Don't set that stuff up until you're ready for it. There are benefits to setting up a corporation, certainly, an S corporation, but if you're just a small business and you're starting out, get your feet wet as a sole proprietor.
See,
And you can do whatever you want to with the LLC.
I've got 3 LLCs and I pay taxes on all 3 and they're all recognized and fill out separate forms. I mean, my tax reforms report's 200 pages. So I'm not following exactly where you're saying that's not recognized by the government, because it is.
It's not recognized on your tax return. On your tax return, you have to be something else. Are you reporting on a Schedule C or an E or an F for your LLCs?
Probably a C.
Yeah, yeah. That's because the IRS doesn't recognize an LLC. It's not an entity as the IRS determines what's taxable. So it's a legal entity, it's not a tax entity. So you have to be something else. You're reporting, if you're reporting on a CE or F, you're reporting as a sole proprietor. And that is, there are benefits to that.
That goes on your
It's easier.
personal tax return.
And that goes on your personal
Right.
tax return. It's
It all
easier.
flows up into your personal.
Yeah, it comes right on to your personal
Right.
return. There aren't any extra fees. The LLC requires a state form
Right.
that you have to pay $175 for, but there are no federal requirements for an LLC. So, like I said, my advice is for a small business starting up, get your feet wet as a sole proprietor. And when you get to the point where you're paying self-employment taxes through the nose because you're making profits, then you need to look at, do I need to go to a corporation? Do I need to go to an S corp? What do I need to do to lessen my tax burden? But if you jump right into an S corp before you're ready, you're going to create an administrative requirement that you don't need. At least that's my opinion. I'm sure there are some people that would disagree. There are benefits of going to the S corp, and that is being able to take a reasonable salary and paying yourself dividends that are taxed only at your ordinary rate. But a lot of people aren't there yet. Anybody else?